When you're buying a home, you better be prepared for the costs that come along with it. And I'm not talking about your down payment. What I'm talking about are your closing costs. Now, some of you may be familiar with the fact that closing costs are a part of the home buying process, but others may not. So we're gonna talk about 3 ways to eliminate those costs. But first, let's talk about what closing costs are, right? So your closing costs are gonna be things such as any charges from the lender, could be costs that come from the title company who's handling the closing on your transaction. Depending on the state where you're buying, there will be state or government charges. It's gonna be setting up an escrow account. Your escrow account is an account where property taxes and homeowners insurance are held by the lender, but that account is established at the time of closing. So that money needs to be collected from you at that time and becomes part of your closing costs. It's also included an appraisal, a property survey, and many other costs, and it adds up quickly. Now, how can you reduce those costs or eliminate those costs altogether? Well, let's talk a little bit about that. So an example of an easy way to reduce the cost is going to be to just waive your escrows, right? So I just mentioned what escrows were. They're property taxes and their homeowners insurance that are collected by the lender up front, but they're also collected from you as the homeowner or borrower on a monthly basis. But you have the option to waive your escrows, assuming you're getting either a conventional mortgage or a VA mortgage. And by waiving the escrow, you don't need to collect that money up front, nor does it need to be collected from you monthly. But by not collecting it up front, it could reduce your closing costs by thousands of dollars. Now, it's not truly saving you money because you still have to pay taxes, you still have to pay insurance. There's no way to not have to do that. But I'm talking about specifically at the time of closing because you may have budgeted enough money for the down payment, but maybe didn't budget quite enough to go toward those additional costs in your closing costs. Now, let's just say that's not an option. You're getting an FHA mortgage as an example, or you don't feel comfortable not having property taxes and insurance as part of your monthly payment because you don't want to have to budget all year for the taxes and insurance to be paid once those are due. Well, that's where something called a seller concession or a seller credit comes into play. So a seller concession or seller credit, they're both the same thing, just different terminology, is a credit that comes from the seller of the property you're buying that will go toward your closing costs. Now, it cannot go toward your down payment. No matter what, the down payment needs to come from you. And if you want to learn more about different down payment sources, please check out my video that gets into much more detail on down payment assistance and other types of down payment programs that are available. But assuming you just need assistance to cover the closing costs because you have the down payment covered, that can come in the form of a seller credit or a seller concession. And now these seller credits and concessions can and will vary depending on the type of mortgage it is that you're getting. And I'll get into a little more detail on that in just a few moments. Now, this is something that you need to negotiate with the seller at the time you're submitting an offer on a property. You don't want to decide you need a seller credit after the fact. The only time you might see that is after your home inspection, and maybe there's some items that need to be fixed. And instead of asking the seller to fix those, you might ask your realtor to just ask the seller for a credit toward those, which technically you can't receive, and therefore that credit ends up going toward your closing costs, right? Which would be a seller concession. But in an ideal world, and the proper way to go about this is to negotiate the concessions up front. But it's important that you speak to a lender and get pre-approved before submitting your offer so that you know how much money you need to ask for. You don't want to go into it blind. So by talking to your lender, they can guide you and let you know exactly what to ask for and negotiate in your contract, because you might need to build it into the purchase price. That money has to come from somewhere. And if the seller is expecting a specific amount from the sale of their property, you want to make sure they're getting what they're looking for and you're getting what you're looking for. So just an example, maybe you were wanting to have the seller reduce their purchase price by $10,000, but then you spoke to your lender and you found out you have $10,000 in closing costs that you didn't originally prepare for. Well, rather than asking the seller to reduce the purchase price, let's just say they were asking $400 and you were going to ask them to reduce the price to $390, you might say, you know what, instead of doing that, I'm just going to offer the $400 they're asking for, and I'm going to request a $10,000 seller credit as part of my offer. That way you're getting the concession toward your closing costs, and your offer is more or less the same to the seller as it would have been had you offered $390, not asking for any sort of concessions. Let me show you how this works actually to make it a little bit easier, because some of you are auditory, some of you more visual, right? So let's just say you're buying a $500,000 property, right? And you ask for a 3% seller concession or seller credit. That would be $15,000 that you're asking for. Now, I was saying that the amount you can ask for varies depending on the type of loan you're obtaining, and I'm going to explain how that works. So let's just say you're getting an FHA mortgage. On an FHA mortgage, the maximum seller concession that you can receive is going to be 6% of the sale price. So on $500,000, just for an example, that would be $30,000 maximum that you can ask for. Now, what you want to keep in mind is that whatever concession or credit you get from the seller, it cannot be greater than your closing costs, because like I already said, that concession can only go toward your closing costs. It can't go toward your down payment. So if you negotiate a $30,000 seller credit, but you only need $20,000, well, you're going to lose that extra $10,000 or have to renegotiate to reduce the purchase price and reduce the credit. That's just the pain. So what you want to do is speak to your lender up front and find out exactly what you're going to need. This way you're not asking for a surplus in seller concession. Just get the terms right from the start. But FHA is 6% maximum. If you're getting a conventional mortgage, the maximum amount you can actually receive is going to vary depending on your down payment and how you're planning to occupy the property. So let's just say it's a conventional loan and you're looking to put down anywhere from 0 to 10%. The max seller concession would be 3%. If you're looking to buy a property and put down 10 to 25%, the maximum seller credit is 6%. And if you're looking to put down 25% or more, you can actually receive up to 9% as a seller concession. Now, that 9% or 6% really only comes into play in a couple of areas. Is one, on lower priced properties, because some of the costs that you incur when you're buying a property are fixed. So they're not going to vary depending on the price point, right? So if you're buying a $100,000 property and there's a $2,000 fixed cost, that's already 2% of that $100,000. Versus if that property were $500,000, it's a much smaller percentage, for example. That's one thing. Two is those higher seller concessions come into play when you're asking for money toward temporary rate buy downs, which get to be very expensive. And if you want to know about rate buy downs, specifically temporary rate buy downs, which have become extremely popular in a higher interest rate environment, make sure to watch my video on rate buy downs, and I give a detailed explanation of how those work and the costs to do those. But that's where those higher seller concessions come into play. Let's just say you're doing a VA mortgage, you're a veteran. Well, the maximum seller credit you can receive is 4%. Right? So it's important to understand what your max concessions could be based on the type of loan you're obtaining and what your down payment is going to be. But that's information that should be coming to you from your lender. Now, there are pros and cons of relying on seller concessions. I've seen situations where you might negotiate a seller concession and the realtor for the listing agent, the realtor for the seller might come back and say, yeah, we'll agree to this. However, if the appraisal comes in low, we're going to reduce that seller concession by whatever the shortage is in the appraisal. So an example, let's just say you negotiated a seller concession of $10,000 on a $400,000 purchase. And that appraisal comes in at $395,000. So $5,000 short of the agreed upon purchase price. In that scenario, the seller might reduce your $10,000 seller credit by $5,000. And therefore, now you only have a $5,000 seller concession, which might not be enough to cover what it is you needed to make the deal work. So that's a con to relying on seller concessions. A pro is that it reduces your out-of-pocket cost, right? So it's pretty simple. Any money that's coming from someone else and not from you leaves more money in your bank account, assuming you had it. If you needed the money to even qualify, it's an even bigger pro because you wouldn't have been buying a home without that seller concession. So I would say there's more pros than there are cons for those things. The easiest place to search these programs is on Freddie Mac's website, which is dpa1.freddiemac.com. It's dpaone.freddiemac.com. And you'll be able to search all of these programs based on your specific criteria. Because there are so many, it will be able to show you which ones are best for you. Now, the eligibility requirements are different for each, so make sure that you read through and see whether or not you're going to be qualified and eligible for the programs that appear on that website. But that's going to at least cover your down payment. So combine that with a seller concession that covers your closing costs, and you can potentially get into a property with none of your own funds out of pocket. Now, if those aren't options, there are others available when it comes to the closing costs. Now, you might have heard of no closing costs mortgages. Well, technically, there's no such thing as a no closing costs mortgage. And the reason there's no such thing as a no closing costs mortgage is because most of the costs that you incur when you're buying a property do not come from the mortgage company. And therefore, there's no way for a mortgage company to make you have no closing costs. However, there are ways for the mortgage company to cover your closing costs, which is as close to a no closing costs mortgage as you can potentially get. So how does it work actually? What has to happen? What's the trade-off in order to be able to have a no closing costs, quote unquote, mortgage? Well, what's actually happening when you do a no closing costs mortgage is you're taking a higher interest rate on the mortgage than what you would have received had you had your own funds to cover those closing costs. Now, I think these are most beneficial in situations where you're looking to keep the mortgage a shorter period of time. If you're looking to keep it long term, it doesn't make sense to take a higher interest rate because now you're paying more interest over the long term. However, it is beneficial if you know you're going to have a mortgage for a finite amount of time. Let's call it 2 years. And I'm going to give you an example here. So let's just say you determined that you're only going to have the mortgage for 2 years, either because you're planning to sell the property or you know beyond a doubt that you're going to refinance that mortgage within the first 2 years that you have it. Well, in those situations, it makes sense to take a higher rate and therefore have a no closing costs mortgage. So let's just say you have a $500,000 mortgage at 6.25% interest over 30 years. Your principal and interest payment would be just under $3,080 per month. And let's compare that, right? That's your regular closing costs. Let's call them $10,000 on that loan. You opt to see a higher rate, no closing costs option. So you take a $500,000 loan, you take a 7.25% interest rate, a full percent higher. Oh my God, I'm not taking that. Well, here's why you would take it if you know you're only keeping a loan 2 years. That same 10 grand you would have had to pay is covered by your lender. So you have no closing costs. Your payment is higher by $332. It's $34.11 per month for the principal and interest. This doesn't include tax and insurance, but either way, those things will be the same no matter what. What we all need to compare is principal and interest. So you're paying $332 more per month at the higher interest rate, no closing costs, than you would at the lower interest rate with the $10,000 of closing costs. So how do we figure out the benefit? Well, we take the difference in the payment multiplied by the maximum amount of time you plan to keep the mortgage. So if you're paying $332 more per month and you know you're only going to keep this mortgage for 24 months maximum, you multiply $332 by 24, it equals $7,968. So what's lower? $7,968 or $10,000? $7,968. So by taking the higher interest rate, which might have seemed crazy, but not paying $10,000 in closing costs like you did at the lower rate, you're actually saving a little over $2,000 on that mortgage option. So it's important to know what you plan to do and how long you plan to keep a mortgage before you make the decision as to whether or not a no closing costs option is right for you. Now, you only want to really utilize that in situations where you can't get the seller concessions that we've been talking about. So if you felt this information was helpful, please leave a comment below. I respond to 100% of the comments left on my page, and make sure to subscribe for more videos just like this one.